Friends, welcome. Pretty excited to resurface this webinar that Alex Dunbar and I did earlier on this year. And the reason why we're resurfacing it is because we're seeing three main mistakes that keep happening, and literally people are getting blocked with their mortgage last minute. They're losing a deposit, or they have to start the process all over again, and they're wasting a ton of time. So in this video, we're going to go over three main things, and the first thing is, this is all about understanding how much you can afford. That's the first thing. A lot of people don't understand how much they can afford. It's based off of your down payment, based off your income, and based off your debt. So we're going to go into that again, just so you really understand how you can position yourself, even if you're still early on in the process. Secondly, minimum credit score, and also other factors that affect your credit score beyond paying your bills on time. A lot of people don't know this. And the third thing is, it's crazy. A lot of people get turned down, not because of their income or their debt or even their credit score. It's because the property itself either has had past water damage, or it's a co-op, or it's age restricted. Some weird stuff that you'll probably read about in the strata documents. Those are things you really got to pay extra attention to. So without further ado, enjoy the video. And as always, if you have any questions, let me know. So yes, surprises to avoid. And again, I've covered the tip of the iceberg, but I'm gonna dive a little bit deeper in like the most common mistakes that I see. So a lot of people just afford less than they want. So they'll go to Alex, hey Alex, I want a $800,000 home. Alex is like, well, he'll probably be like, are you pre-approved? Right? Some realtors may not, or you may just be looking at listings online and like you're house shopping, but if you don't know what you can afford, you're kind of wasting your time. So get pre-approved, and that's basically having a call with me either on Zoom or a phone or in person if you like, of course at a safe physical distance, just to kind of assess a bit of your profile. And then, yeah, you basically have a stamp of approval, whether it's an official pre-approval through a written one that I can get from some of my lenders, or I give you a 95% estimate on where you're at right now and where you can go in the future. So that's really important. So know what you need. A lot of people pay more than they need to, mainly because of credit score. They just don't know their credit score, nor what actually affects your credit score. Remember, 35% of what affects your credit score is paying your bills on time. The rest, usually people don't know about. So we'll talk about that in one of the subsequent slides. And then, yeah, one thing as well, the reason why I said that I can pre-approve you to 95% of what I think is going to get you to, of course, certainty, is that your home actually influences a lot of how much you can afford for your mortgage. You can, let's say you make $500,000 a year, zero debt, and a perfect credit score of 900. You may still get turned down, because think about it. If you're a lender and you're giving, and their only collateral for you maybe not paying is the home, and the home is water damage or anything like that, that will actually get you blocked at the last minute. And I see it time and time again. There's that thing. And of course, yeah, if you don't have a big enough of a down payment for the value of your home, if your home's over $1 million, you're in trouble. So you really got to know the relationship between the home value, and how that affects you. So again, on the pre-approval side, this is something that, again, you can look at after today's chat. But end of the day, a pre-approval is when you are seeing how much you can afford and at what rate. Something people also don't know is, as you guys know, the rates right now are below 2%. That's close to historic lows. So that probably won't last forever. And if you do get a pre-approval, you can actually sometimes get a rate lock, like a rate hold. So if the rates do go up, and you're within an 120-day window, sometimes even more, depending on the lender, that rate, you get an honor on that rate. And if the rate actually goes down, they can float you down to what's actually lower than what you got locked in at. So it's kind of a way to hedge your bets. It takes precisely 28 minutes. I've timed some of it, and it basically is less than half an hour. And you can save 10 grand on this, because actually, if you go back to a little bit of math, if you have a rate of 2.10, and let's say in 4 months, it shoots up to 3.10, which, it doesn't happen very often, but it has happened. Then the difference between getting a 2.10 and a $500,000 mortgage, and then having to pay a 3.10 because you didn't get pre-approved and you didn't lock a rate, is $10,000. So do your due diligence. It doesn't take long, and it lets you know where you're going. I have a lot of this on the blog. You guys can check out on levelupmortgages.com, and of course we can chat about it as well. An asterisk here too is if you're getting to pre-construction condos, which Alex will cover more. Sometimes they won't close for like half a year or a year. And there's special mortgages that let you hold on to either the rate or be pre-approved for a certain amount of time, longer than 120 days. And then you have to refresh your application. But you have to get pre-approved so that you can put in that deposit with confidence. And then once it's going to complete, once you actually move in, you've got to refresh that. And we can talk about that later. But that's a bit about pre-approvals. And then, yeah, credit score. So here is me unveiling what actually affects your credit score. So the first thing is, good payment history. That's you paying your bills on time. Credit utilization. This is, and the way I actually pay my bills on time without stress is I just set up pre-authorized payments. Call up your bank. It's all in autopilot. They'll pay the monthly credit card fee, and boom, it's out of sight, out of mind. Which is personally a way I like to do it. Credit utilization. If your credit limit is $10,000 on your credit card or your line of credit, if you are spending $4,001, that's starting to affect your credit in a negative way. If you're at $8,000, that is not good because they know you're towing the line. So that's actually like almost as important as paying on time. So a way to avoid this is to get more lines of credit or more credit cards, of course, in a responsible way. And in total, you want to be under 40% of what the aggregate of your credit limit is. Really important. And one thing as well is don't close your credit cards once you're not using them or your lines of credit. Try to keep them active. There's a rule that says to build credit, you need 2 lines of credit. You've got to have them for at least 2 years, and you want to be paying the difference at least twice over, right? So it's a very important rule that can keep your credit card active. So basically, you want to keep your lines active, even if it's just paying for something on a credit card you never use, $20, and then paying it back. Question right now, a quick one. With annual fees, sometimes the cards have annual fees, so you have to do the pros and cons of that. Look, if you are within 6 months to a year of actually getting a mortgage or in the market, I would say pay the $100 because the risk of that dinging your credit score is probably going to be more costly than you having to pay more for another lender. But again, talk to your local mortgage broker and find out what your score is. If you're like a 800 or 750, this might affect it, 5, 10, 15 points, right? Which isn't that much, right? Just consult, but just know that actually affects your score. Again, do not cancel credit lines, especially if you're within a year of doing it. And the consequences are that you may have to pay more interest with alternative lenders. So those are lenders that still don't have the worst rates, but they're a little bit more, right? And they'll be more flexible on your credit, by the way. And there's definitely a time and place for them. But, if you can avoid them, it's probably better. And with any alternative lender, these are people that maybe charge between 3.7 and 6%. You have to put down at least 20%. So just by not keeping your credit score where it needs to be, you could be just having to save a lot more money or pay more than you need to. So just talking about the home really quick, I mentioned this. Ask your realtor, ask Alex, ask whoever, what are the building features that may cause concern? And these are all things here that you just have to basically ask your realtor about and they'll know. But just know what questions to ask because for all these reasons, lenders won't touch a building if it's not good collateral. Really important. There's a cool tool as well called the Eli report that actually uses AI to review some of your strata docs. So that's something as well you can kind of talk to your realtor about if they don't know about it. And you can also save some time because it can be, of course, a lot of paperwork and very overwhelming. Things like age restrictions. Some buildings only allow people 55 plus, which is great because it's quiet for them. But when it comes to selling that, the lenders see it as they have a limited market and therefore they may not see it as something they want to lend on. Some buildings have a large fund as well, a contingency reserve fund, like a fund basically to repair damage. And you actually want to sometimes ask, like, what is the contingency reserve fund? And they'll be like, oh, I'm surprised you know about that. But that's actually really important to understand how much there is for backup if something happens. And one thing as well is that, let's say Alex gets you a really good deal on a property. You may have the issue where he gets you a good deal and you or how about this? Let's say that, let's put it this way, actually. You actually have to pay more than the property is worth, okay? You have to pay more. It's a bidding war, so you have to pay a little bit more. It's still a good deal because you love the property. You pay $600,000 for the property, but the market rate for it is actually $500 or $550. Now, that means that the lender, when they order an appraisal, so they actually see how much it officially is worth, not through negotiation, but the market price. If they get $550, they will lend to you based off the price of $550 which means you're probably going to be $50,000 short on the mortgage. So it's actually very important that if you do pay more than what is the market rate, that can limit you in how much mortgage you get, and the rest comes out of pocket. So make sure that for your appraisal, you understand that even the minimum appraisal out there will still not affect what you have to pay on the down payment side.
All right, friends, that's it for today. Look, if you have any comments or any specific questions to the 3 things we talked about, please leave them down below. I mean, again, it's really important around, like, you know, what are your strategies for keeping your credit score high? What's your down payment strategy? Do you understand how the debt to income ratios work, right? Those are all really important aspects. And lastly, if you have any thoughts or questions around potential landmines that your building might have that might block the deal, get in touch with me or leave a comment below. With that, make sure that, of course, that you hit the bell so that you are subscribed for updates. Subscribe, of course, to the channel if you want to get the next video. And folks, as always, you can follow us online or through social. And please, please, please do not forget to keep leveling up your living.